Assalamu alaikum. Welcome to lecture 37 of SBR IFRS 15, which is revenue from contracts with customer. This is a major standard in your SBR. See, some standards, although there are so many standards, okay, if you take all IAs and IFRS, there are some standards which are very major standard. I mean, the standards are big enough and it has a very huge chance of appearing in your SBR exam, right? One is IFRS 15. Then we have leases, which is IFRS 16. Then we have IFRS 3, IFRS 10, IS 12. These standards are a heavy standard. I mean, you need to focus more on the standards. Why? Because this is an area, it's a big area, and examiners often ask from this area. Okay? They might ask some portion of it, but they ask. Okay? IFRS 15 is usually tested very frequently. So now you can understand the depth of the standard. You have to be very thorough with this standard, okay? Because whenever this standard comes, it comes with very huge amount of marks. Lots of marks is there for this standard. Let's say around, sometimes it could be for 15-20 marks, okay? I'm not scaring you, but that's a fact. Sometimes it could come as a small question, let's say 5-10 marks, okay? So let's go through the content. We are first going to start with revenue recognition. Revenue recognition has 5 steps, okay, and each steps will be explained in detail throughout this lecture. Mostly, examiner, out of all the areas, there are so many areas, the first area is mostly tested, that is revenue recognition. So your focus has to be more on that. I'm not saying others are not important, but that is mainly, you have to know it, it's a must. Then next is contract modification, contract cost, presentation, disclosure, and judgment. See, this revenue recognition is just not any revenue. This is from contracts. That means if you have a contract with a customer to give something, how do you recognize revenue? This is about that. Now, these are the 5-step process that you need to know, and it's in the order. First, you identify the contract. Second, you identify the separate performance obligation. That means in order to fulfill the contract, one is to fulfill the performance obligation. Obviously, every contract has an obligation. Here also, it is known as performance obligation. Performance obligation means which good or which services are you going to give. You specify that in the contract. Okay, let's say I have a contract to sell a building. So that building is a performance obligation. I have a obligation to sell a building with a service. So that building is one performance obligation and that service is another performance obligation. Two performance obligation. I hope you are able to picture it, right? Understand. Anyway, we'll go through it in detail with questions. You'll be able to understand it better. Third, transaction price. Everything has a price, so you have to determine it. 4, allocate the transaction price to the performance obligation. As I told you, a contract might have 3, 4, or 1 or 2 performance obligation. So you need to set the price for each performance obligation. How much will be the price? Because when you're setting the transaction price in step 3, that is a one price only for the whole contract. Now for each performance obligation, you need to, from the transaction price, you have to allocate. And number 5, finally, you recognize the revenue. So revenue recognition comes as the last step. Before that, you have to go through the other 4 steps. Okay. And when do you recognize the revenue? When you have satisfied the performance obligation. Okay. That means when you actually sold the good or the service. That is the meaning of satisfaction of performance obligation. So now we'll illustrate these 5 steps before we move on in detail, starting with step 1, that is identify contract, then 2, then 3, then 4, then 5. Okay. Now, illustration 1. Okay, the 5 steps. Remember, in your actual SBR exam, they will not ask all the 5 steps. Okay, you need to know that. It's a note. Okay, they will not ask all the 5 steps. They can never do that. Why? Because due to time limit, and also if they ask all the 5 steps, they have to ask other questions from other standard, right? They cannot entirely test IFRS 15 on all these 5 steps only. So in your SBR exam, the actual exam, they will ask 1 or 2 steps out of the 5. It could be any, but mostly revenue recognition is one, and the other one could be anything. Step 1, step 2, step 3, or step 4. Okay, but in short, you need to know all the 5 steps thoroughly. Okay. So now let's start with step 1. Step 1 is what? You need to identify the contract. Is there a contract? You need to read the case study for it. Okay. Wade receives an order from a customer for a computer. Wade delivers the computer to the customer. Customer paid the amount. If sold individually, the selling price is this much. The customer paid 420. If sold individually, the selling price of computer is 300. Out of this 420, 300 is for computer and 120 is for the technical support. That's how they have divided it. Okay. And they have a 12-month contract. They have sold this computer also, transferred his legal title to the customer on the same day. Okay. They have received an order from a customer. Okay. So this shows step 1 is satisfied. There is a contract between Wade and the customer because they have a order to sell computer with technical support. Okay. Also technical support. So step 1 is fulfilled. Okay. What about step 2? Okay, I will write the steps for you. I know otherwise it's very confusing. Step 1 is identify the contract. So here you need to write, just identify the contract is not enough. You need to explain. So there is an agreement. Okay. There is an agreement between Wade and its customer. For computer and technical support. Okay, this is how you need to write your answer. Now coming to step 2. What is step 2? Can you recall? Just now in the previous slide we went through. Step 1 is identify contract. Step 2 is identify separate performance obligation in the contract. Identify separate performance obligation. How many obligations are there? There are 2. Okay, 2. What are they? 2 performance obligation. PO, I'm writing short form. 2 POs are there. Performance obligation means promises. Okay, promise to sell this good, promise to sell this service. That is the meaning of performance obligation. Okay, one is supply of the computer. This is one performance obligation. The other one is supply of technical support. Okay, if there is one performance obligation only, there is no issue. Okay, it could be more than 2 also. Step 3. What is step 3? Transaction price. You have to determine the transaction price. Already they have given you the standalone price, that is 420. So total transaction price is what? 420. Coming to step 4. Allocate this transaction price to performance obligation. Allocate transaction price TP to PO, performance obligation. So out of this 420, they have already given you 300 goes to computer and 120 is for TS, technical support. Okay, now moving on to step 5. This is the tricky part, revenue recognition. See, you need to know one more thing about revenue recognition which I have not explained you before. Revenue could be recognized in 2 ways. At a point in time, over a period of time. What is the meaning of at a point in time? At a point in time means when you are giving, this is usually very common with goods. For example, when you are giving the good, you're delivering the good to the customer. That is, at one point you have delivered it. So at that point you can recognize the revenue. Okay, this is mostly for computer in this case. The next one is over a period of time. This is usually like so for services, because services, let's say you are giving services for 1 year, 2 years, it's over a period of time. It's just not at a point in time. You see, so when you're recognizing revenue, you cannot recognize. You have to spread that revenue over the period of the service. So that means how are you going to recognize revenue for this? In this case, it is technical support that is recognized over a period of time, because they have given that technical support over, if you see up, it is months, 12 months of technical support. But computer is one thing, you're just giving it on one day. But technical support is not a thing that you just give it on one day, it's over a period of time, 12 months. Okay, how do you recognize? However much you have completed that service. Okay, so let's recognize revenue. This 300 for computer you can recognize because you have sold the computer at the same day, so you can recognize this 300 as a revenue entirely on that date. On which date? 1st December 2001. This is the date you have sold the computer to the customer. Legal title went to the customer. Because the control, always see who has the control of the asset. Control of the computer has been passed to the customer. So this you will recognize. What about technical support? What about this 120? Can you recognize this 120 entirely for technical support? No. It's over a period of time. You need to divide this 120 over 12 months and recognize for 1 month only, which is 10. So only $10 you can recognize as a revenue. So the total revenue will be 310. 300 plus 10 of technical support. Okay. And even this also, this you will recognize by end of 31st December 2001, the technical support. See here, the date. On 1st of December 2001, this date, they received an order, and on the same date, they have sold the legal title to the customer. So on this date, you can recognize revenue. But coming to service, technical support, you will recognize at the end of 31st December 2001. Okay, because it is just for 1 month. You see, from 1st of December to 31st December, just 1 month, you have used the technical support. So you can only recognize for 1 month. Okay, now we'll go in detail in the 5 steps. Step 1, identify the contract. Here, a contract between two parties. Okay, a contract is an agreement between two parties that creates rights and obligation. One party will have the right, the other one will have an obligation, and is vice versa. It's the same. Okay, now a contract does not need to be written. It could be an oral contract also, anything, verbally also. But it's always better if it's written, so that evidence is there if later on disputes happens and all. But even if it's not written, it's a contract if this following things are there. It needs to meet the following criteria. Okay, you can only account for revenue from a contract if it meets the following criteria. Just any contract you cannot recognize a revenue. It has to have this characteristics. Number 1, parties has to approve, both parties have to approve that contract, and each party's rights can be identified. Who is giving to whom what, who is entitled to receive what, who is entitled to pay what. It will be clearly there in the contract, and both parties have to approve the contract. If one party is approving, the other one is not approving, it's not a contract. Okay. Second, payment terms. You will see in the contract the payment terms. If payment terms cannot be identified, you cannot recognize the revenue for that contract. So this criteria are very strict. Okay. 3, the contract must have a commercial substance. It is for commercial reasons, not for any personal reasons or something. And last, there should be a probability that entity will be paid. Okay, so if these 4 criteria are there, then you can recognize the revenue from a contract. Now moving to step 2, identifying a separate performance obligation. Okay, performance obligations are basically promises to transfer goods and services. Okay, now as we saw in the previous question, in one contract there could be more than one performance obligation, like computer and technical support. Now there are some more examples, like a car. If you have a contract to sell a car to a customer, with that car you might have 1 year's free servicing and maintenance. So there are now two performance obligation. One is the car, the other one is 1 year's free service and maintenance. Second example is, let's say you have a contract to provide 5 lecture as well as a textbook. So that 5 lecture is one. Remember, 5 lectures are not separate 5 performance obligation. No, 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 no. 5 lectures is one performance obligation. The textbook is another performance obligation, because this 5 lectures is, each lecture is same. So you can combine them together. Understanding? You can bundle. When it's similar, you combine them. But lecture and textbook are different nature. Lecture is a service, textbook is a good. You cannot combine them. They are distinct from each other. Okay. Now, so basically, distinct performance obligation within a contract must be identified. Okay. Now, a good or a service is distinct if it has these things. Not any good or services are distinct. One is, customer can benefit from that good or service on its own. Let's say our textbook in the previous example. Can the customer benefit, student benefit from the textbook? Yes. Can they benefit from the lecture alone without the textbook? Yes. So there are two separate goods and services. Next, the promise to provide goods and services is separately identifiable from the other contractual promises. Let's say in a contract there are so many promises, but you need to understand which one is the distinct goods and services in that contract. Don't worry, it might look little difficult, but trust me, it's the easiest thing. Okay, the difficult thing is recognizing revenue. All the other 4 steps is pretty easy. Okay, you will not struggle so much. So we'll do a question, okay, shortly, so that you will understand clearly all the 5 steps. Okay, now let's go through the performance obligation before we move on to step 3. Now let us go through an example to understand performance obligation better. Okay, that is the construction of a school. So with this example, you'll be very clear with your performance obligation. Now, Sterling has a contract to build a school. What is the contract? To build a school for one of its customers. Now, we all know that to make school, there are so many things. Okay, to fulfill that contract, they must provide services, like they have to clear the site, they have to lay the foundation, they have to procure the material, construction, wiring of the building, installation of equipment, and decoration. All these things are there. So it might look like that there are so many separate performance obligations, right? Wrong. We'll see later why. Okay. Now if you see, we told earlier that if a customer can benefit from each of the services or goods individually, it is a performance obligation, right? It is true. Customer can benefit from each of these services individually. How do we know that? Because we can purchase this separately from a range of entities. Each different entities are giving these services separately. So it shows that separately also you can benefit from these services. But they are not separately identifiable, these services. Why? Because they are being contracted to significantly integrate them into an identified output, that is school. Why is it made? All these are supporting activities. They are done to build that school. Your main contract is to build the school. So with that building, you need all this. It's like an integrated part. It automatically comes with that school. Okay. That's why these are not separate performance obligation. Rather, all this clearing site, laying foundation, procuring material, installation of equipment, decoration, wiring of building, all of this together account for single performance obligation. What is that performance obligation? To build school. School is your performance obligation. With that school, whatever comes, they are not separate performance obligation. They are taken as one only. So all the promises services a single performance obligation. Now do you understand? Or in other words, if you say supporting activities are not taken as a separate performance obligation. This wiring of building, decoration are supporting activities to build that school. You understand? So they are taken a single performance obligation. I hope after this you will never get confused with the performance obligation. Okay. Next, you need to know about the nature of performance obligation. Okay. So IFRS 15 says if the good and services is provided by you, that means you are the principal. That performance obligation. Okay. If you hire someone else to provide goods or services on your behalf, then it's an agent. That part is an agent. So for each, if you're a principal and if you're an agent, how do you recognize performance obligation? You need to know this. Okay. If an entity is the principal, okay, an entity is the principal if it controls the goods and services before it is transferred to the buyer. Okay. That means it's your own goods and services. You have the control and now you're passing that control to the customer. This is the normal scenario that we just went through. So the moment you pass the goods and services to the customer, you recognize revenue. That means performance obligation has been satisfied. And if the entity is an agent, how will they recognize the revenue? Revenue is recognized based on the fee that they receive, the commission that they receive. Because the goods and services is not their own, it is the principals. So for agent, you cannot say when goods and services are transferred to the buyer you will recognize revenue. No, it is only for the principal. For agent, only the fee is recognized as a revenue. Now, warranties. We know that sometimes warranties are there. It comes with many products, right? But there are two things that you need to know about warranties. Sometimes, okay, first of all, what is warranty? Warranty is an assurance that product will function as it was said. Okay, let's say it will function for 1 year, 2 year. Okay, they give so many warranties in so many electronic products. They give warranties like watch or so many things, right? If this is the case, remember the warranty will be accounted according to IS 37, that is provision, contingent asset and contingent liability, according to provision basically. What is IS 37? If you want to know the rulings of IS 37, you need to go back to my lecture IS 37. You will get it from my SBR playlist, SBR lecture, that is from September 2022 to June 2023. It is labeled like that playlist. Go there. It is in order. Okay, it is number wise. I started with IS 1, so you will get it there somewhere IS 37 before IFRS started. Go there and check the ruling for provision. Exactly the same ruling you have to apply for warranties. Okay, but if a customer has an option, see, if warranty is normally given with the product, IS 37, but if the customer has an option to purchase extra warranty separately, then it is a distinct performance obligation. That means with the product, now you have a performance obligation, that is warranty also. If option is there where customer can choose to purchase it separately, then it should be, then that transaction price is allocated to this warranties also. Okay, portion of that transaction price is now allocated to warranties also. You need to know the nature of this. Either the customer has an option or it is given with the good only, the warranty, where customer does not have an option, then it's IS 37. Now, step 3, determining the transaction price. This is easier compared to all the other steps. Okay, because this is basically about the price. So here, transaction price is what? It is not, it is a price, or let's say amount of consideration that entity expects to receive in exchange for satisfying a performance obligation. Let's say I have sold a good, so I'm entitled to receive the amount that I have sold to you. Okay, I have sold my car, so I'm entitled to receive an amount for that car. That is the transaction price. But sales tax is excluded. Okay, do not include sales tax in your transaction price. Now, when you're determining transaction price, keep the following things in mind. Number 1, transaction price can include these things: variable consideration, where it's variable, not fixed; significant financing component; non-cash consideration; and consideration that is payable to a customer. All these 4 things could be this. All these are part of transaction price. We'll go in detail one by one, starting with variable consideration. Variable, as the name says, is variable. It keeps changing. Okay, but for variable, IFRS 15 says estimate can only be included. That means this variable consideration you can only include in the transaction price if the probability is very high that the significant reversal of that amount that you have recognized as a revenue will not reverse when uncertainty is resolved. Later on, when you come to know about the event, let's say you have recognized the revenue today, but let's say the later revenue is something else. So it should not lead to reversal of that revenue that you've already recognized if when uncertainty is resolved. If it is so, then you cannot include variable consideration in your transaction price. If reversal is not unlikely to happen, yes, you can include transaction price. So it is based on the probability of reversal or not. Next, note that if the product is sold with a right to return, then the consideration is variable. Okay. The entity must estimate the variable consideration. See, you have to estimate. Okay. Estimate the variable consideration and then decide whether or not to include this in the transaction price. And refund liability. What is refund liability? Refund liability should equal your consideration received or receivable that the entity does not expect to be entitled to. See, this is not something that you are entitled to. You might sometimes get a refund liability or sometimes you might not get. But it is not something that you are entitled to and you should get. Okay. So this is a part of a variable consideration. Before we move on to the next, that is significant financing component, let's do a small question on this. Test understanding one Bristow. Okay. Now, there are two treatments according to two situations. How will be the accounting treatment? A, where Bistro has an experience of providing identical services in the past and is highly probable that number of mistakes made will fall below the acceptable threshold. B, he has no experience and unsure whether the mistakes will fall below the threshold level or not. First, we'll read the case study a little. So on 1st of December, Bristow provides a service to a customer for next 12 months. Consideration is 12 million. Bristow is entitled to an extra 3 million if after 12 months. You see, there's a condition attached to it. This next three, if they want to get the 3 million more. If after 12 months, the number of mistakes falls below a certain threshold. So in the A, the probability is likely that it will fall. B, unlikely. So how you will recognize the revenue? That is the whole question. First, you need to understand that this 12 million, is a fixed consideration or fixed transaction price. Let's say fixed consideration. You cannot do any changes to it, whether under A or B. The only thing is about 3 million, whether we are going to get the 3 million or we are going to lose the 3 million. So according to A, we said, so that means 3 is a variable consideration that you need to understand. This 3 million is the variable consideration. Whether we'll include it in the transaction price or not, let's see. That means with this 12 million should be added or not. Okay, 12, no matter what the situation is, we are going to take it. But 3 is based on a situation. It's variable. Can keep changing. Variable means it changes. It's not fixed. So according to A, okay, they are most likely to receive they are likely to hit the target. Why? Because it has been done in the past. They have experience and there's a high probability the number of mistakes will fall below the threshold level. Right? So it seems probable that significant reversal in revenue recognized will not occur. Okay, that means the transaction price is 12 plus 3, which is 15. But this 15 is over 12 months for 1 month only. You went on 1st of December and you have to account it on 31st December, 1 month. So 15 divided by 12 months. It says 1.5. 1.25, I'm sorry. 1.25, this is the revenue according to A. Okay. Now, coming to B. B is unlikely because they don't have a past experience. So it's unlikely that this variable consideration will be added. Because if you do, it is highly probable that reversal of revenue recognized will take place. That's why it's just 12. So this 12, now you need to divide by 12 months to find the revenue. It's 1 million. This is the revenue according to B. Now let's move on to test understanding 2. Test understanding 2. Now join. Okay. How the above transaction will be accounted. He enters into 50 contracts with customers. Okay, each contract, that means each of this 50 includes sale of one product for 1000. Okay, the cost is 400 each product is 400. Cash is received upfront and control of the product transfers on delivery. Customers can return the product within 30 days to receive a full refund. Narden can sell the returned products at a profit. They have a significant experience in estimating the returns for this product. It estimates that 48 products will not be returned. That means how many products will be returned out of 50? 2. If 50 are not returned, 48 are not returned out of 50 means only 2 are returned. Okay. Step by step we'll tackle this question. This needs to be broken down into chunks. It's a big chunk. I know it's too much. Okay. First of all, the fact that customer can return the product means consideration is variable. Okay. Can return the product. Whenever you can return the product, consideration is variable. You need to know this. Why is variable? Because even return or not is also, you're not sure. You might or you might not return. That's why. Next. Now we'll find out the variable consideration. Basically the sales. So you see 48 has not been returned and each has been sold for 1000. So just multiply it. 48 products with 1000. That has been sold. That has not been returned. 48,000. Okay. So this 48,000 is your variable consideration. And also this should be included in the transaction price. Included in transaction price, TP. Why? Give reasons. Because based on Nadon's experience, there is a probability that reversal will not. Okay. They have significant experience, okay, on this, where they say that they can sell the goods that have been returned at a profit. It shows that this you can include in your transaction price, the 48,000. Next, you need to calculate a refund liability. So revenue is, this is the revenue, okay, 48,000 is the revenue. What about the refund liability? See how many you're returning to. Out of the 1000, you are losing this. From that you could have got this much of revenue. Total 50 into 1000 you are selling 50,000. But out of that 50,000, you see 48,000 is only as revenue. What about the remaining 2,000 that has been returned? This is a refund liability. Okay. It's a refund liability. You have to recognize this, by the way, that 2,000. Okay. As a refund liability. Next, the last step. See, you have transferred, they told that they have transferred something to the customer, right? Cash is received upfront and control of the product transfers on delivery. Now, what should Nardan do? De-recognize the inventory transferred. They have to de-recognize the inventory transferred. You must have transferred an inventory. Now you have to de-recognize it. Why? Because you have goods that are returned. Okay, transferred to his customers. But they should recognize an asset instead. How much? How many products they are returning? Only 2 products out of 50. Into how much? What is the cost? See, the cost of each product is 400. Okay. So we'll check the cost. 2 products into 400, which is 800. So this much you can recognize an asset. Okay, you can recognize an asset of 800 as well as a corresponding credit to cost of sales, as well as credit to COS, cost of sales. From your cost of sales, it will be deducted. Why? For its right to recover products from customers on settling the refund liability. When you settle the refund liability, you have the right to recover the product from the customer. That's why you will still have those inventory in your stock in your company. You understand? So when you're determining transaction price, I told you that there are three. First was variable consideration. That part is over. Second, we are moving on to financing. Now, when you're determining transaction price, you must see the timing of payment. Okay. So entity must consider if the timing of payment provides customer or the entity with a financing benefit. For example, okay, these are the indications of a significant financing component. Number one, the difference between the amount of promised consideration and the cash selling price. That means the amount that has been promised that you're going to receive and the amount that you've actually received in cash. You have to see the difference. Okay. Next, the length of the time between the transfer of the promised goods and the payment date. Sometimes it happens that you have transferred your goods but the payment did not come yet. So the length of the time you have to see. Now, if there is a financing component, then the consideration that is receivable needs to be discounted to present value. Using the rate, which rate you are going to discount? The rate at which customer borrows money. Okay, this all will be given to you in the exam. At which rate customer will borrow money, and you have to discount if the financing component is involved or not. Okay, they will tell you. So now let's do a small question before we move on to the third thing that determines the transaction price. Test your understanding 3 Rude. Okay, this is for the financing component question. Now, Rude enters into a contract with a customer to sell equipment on 31st December 2001. Okay, but and the control has been passed also. The control transfers to the customer on that date. The price is 1 million, which is due on 31st December 2003. You see, there's a difference between the transfer, the control that has been passed, and the payment. So that means there is a financing component that is involved here whenever there's a timing difference. One of the reason is timing difference. Financing component is there. So when financing component is there, you have to discount. Discount rate has been given as 10%. Now you have to discount because you are receiving this in 2 years time. So this 1 million, when you're discounting it, 1 into 1 divided by its 10%. So 1.1 to the power 2. Because for 2 years, it will give you obviously less than 1 million. 826 446. So you have to remember this is not a revenue because revenue will be recognized on 31st December 2003 only. But for 31st December 2001 at this date, at today's date, you will recognize it as receivable. It is something that you're going to receive in the future. You have not yet received. Okay. So now, what do you do that? Remember, receivable is not according to IFRS 15. Receivable is accounted according to some other standard. Can you recall which standard? And what is receivable? Receivable is a financial asset. Right to receive cash. Financial asset. So it's a financial asset, IFRS 9. It is dealt according to IFRS 9. Financial instruments. Okay. So we are over with variable consideration and financing component. The third that helps to determine transaction price is non-cash consideration. If it's a non-cash, any non-cash is measured at fair value. Number one. Number two, if you cannot reliably measure the fair value of non-cash consideration, then you have to use the stand-alone selling price of goods and services that has been promised to the customer. Okay. Now let's do a short question before we move on to the fourth thing that determines a transaction price. Test your understanding for 10 and Stan. Okay. 10 sold goods to Stan. Control over the good was transferred on 1st of Jan 2001. Consideration was 1000 shares. Remember, it's a non-cash. 1000 shares is the consideration received with the fair value of 4. By 31st December, fair value was 5. How do you recognize it on 31st December 2001? Revenue. How revenue is recognized? See, revenue is recognized 1000 into fair value. That is 4000. This is the revenue that you recognize. What about the changes in the fair value of that? That's 5. See, any changes in the fair value of the share is not dealt according to IFRS 15. It is dealt according to IFRS 9 again. Okay. In your SBR exam, you also have to give according to IFRS 9 how the treatment would be. But because in this question it comes under the chapter revenue, they do not explain. They just say simply it goes under IFRS 9 and IFRS 15 does not deal with the subsequent changes in fair value for shares. That's what they have told and left it. But in your actual SBR exam, they have to actually, you have to show the IFRS 9 treatment also. Why? Because SBR 9, SBR, because SBR exam is an integrated exam. It includes all the standard, and one question can include so many standards. So you have to answer from all the standards. IFRS 9, IFRS 15 and whatnot. But because this chapter is specifically for IFRS 15, they will only explain how according to IFRS 15 something will be recognized. Anything outside it, they will just leave it, saying it is dealt according to the standard. That's it. Okay. That is just for your clarification. I have explained it to you. Consideration payable to a customer. The fourth way that determines a transaction price. Now, if consideration has been paid to customer in exchange for a distinct good or services, what happens? Then it should be accounted for as a purchase transaction. Remember, rather than saying, this is like, rather than giving the goods and services that has been promised, I am giving you cash consideration to the customer. So if it is like that, you have to account it as a purchase transaction. A purchase has taken place. This is not a contract transaction. Next, if the consideration paid to a customer is not in exchange for a distinct good or services, you have just paid the consideration to a customer, but it is not in exchange for the goods or services, then that consideration is shown as a reduction from the transaction price. Okay. Now we'll do a small question to show it. Test understanding 5 Golden Gate. Okay. How revenue is recognized for Golden Gate. Golden Gate has a major chain of retail stores. Okay. They enter into a contract with a major chain of retail stores. Customer commits to buy at least 20 million of products over next 12 months. Okay. But the term says that a payment of 1 million. Okay. Golden Gate will make this 1 million payment to the customer to compensate for the changes that is made to the retail store to accommodate the product. Now by 31st December 2001, they have made sales value of 4 million to the customer. They have transferred the product with the sales value of 4 million to the customer. Okay, that means they have recognized sales for 4 million on that date, which you have to change now. First, you need to understand the payment that has been made to the customer. Is it in exchange for the distinct goods or services or not in exchange? In this case, it is not in exchange for the goods and services. It is rather to accommodate for the retail changes in the retail store. Okay, they have still made the transfer of the product. They have told that they have transferred the product. This shows that it is not in exchange for the goods and services, the payment that has been made to the customer. So how will the treatment be done? Reduction in TP, reduction from the transaction price. Okay, now this is how you reduce it. It's not like what do you think? that this 20 million is the price and you reduce 1 and it becomes 19. That's not how it is. This is how you need to reduce it. Memorize it and keep it. Next time you get a similar question, that's how you need to do. So the payment is 1 million to customer. Out of what? Out of 20. So in terms of percentage, you have to find out how much is the reduction, which is 5%, 0.05, 5%. So every the price, whatever the price is allocated to the good, each good, it needs to be reduced by 5%. Okay. Now, so they have recognized a revenue of 4 million by 31st December 2001, right? They have to reduce this revenue because of the consideration that has been made to the customer. How much? 4 million into reducing 5% means you are left with 95%. That means now you have to recognize revenue of 3.8 million. Okay. Step 4, allocate the transaction price. This is the easiest. Okay. So basically, whatever the total transaction price given to you, you allocate to each performance obligation. How? Based on its proportion to its standalone selling price. Each performance obligation, okay, when you allocate in transaction price, it is in proportion to the standalone selling price. Next, if the best evidence, okay, the best evidence is the observable price when goods and services are sold separately. Okay, if you want to get a standalone selling price for each good and services, you have to observe the price of each goods and services separately when they are sold separately, not together. Third, if directly you cannot observe the standalone selling price, then it must be estimated. Okay. Then if a customer is offered discount for buying bundles of goods and services, then this discount have to be allocated across all the performance obligation within the contract in proportion to their standalone selling price, unless the evidence says otherwise. Okay. But even the discount also is allocated across all the performance obligation in that contract if discount has been given. Now let's do a question. Just understand 6. This is regarding your step 4, allocating transaction price to the performance obligation. So here you have selling a machine and 1 year's free technical support for 100,000. You see, together it is 100,000. Separately, the machine is for 95,000. But for technical support, they don't have any observable data. But if they see other support services that are offered by Shred, they attract a markup of 50%. Okay, and this costs 20,000 for technical support. It is expected that technical support will cost 20,000. So this is something they have to estimate. For machine, you don't have to estimate. You can take 95,000 directly because observable evidence has been there. But regarding technical support, you have to make an estimate. Okay. First of all, I know everyone will do this because 100 is the total price. They will deduct 95 and 5,000. They might feel that this is for the technical support, the residual approach. Okay. Well, it would be if you see the price similar in the industry, but they are adding a markup of 50%. That means they are also making a profit. Okay. If you see, this does not approximate to the standalone selling price of similar services. They are making it in profit. So better approach would be what? Check on this one, the similar service. So you see the cost is 20,000, add a 50% markup, that means 150%. It is 300,000. Sorry, 30,000. 30,000. I'm sorry. 30,000. So now the total standalone selling price for technical support is 30. So if you want to get machine and support, machine is 95. Technical support is 30,000. Total is 125,000. Okay, but if you see this 125,000, but if you see the consideration receivable, total consideration receivable is 100,000, isn't it? You see, because in the contract it has been specified 100,000, both machine and support, technical support. But the standalone selling price is 125. You have to pay only 100. So you see, what's happening here? Customer is receiving a discount. Customer is receiving a discount. Why? Because they are buying it together. When you buy something together in a bulk, it costs less rather than buying it separately. So there's a discount because you are getting that technical support along with the machine. Along with what? Yeah, along with the machine. That's why it's costing less. So you are having a discount. So if you're having a discount, let's find out what is the discount. Okay. The difference between these two, 125 and 100, is 25,000 over 125,000. Discount is 20%. This is how you find the discount. Okay. So 20% is the discount. Now, IFRS 15 also says that if you are having a discount, you have to spread it along your all performance obligation. There are two performance obligation here. One is machine, one is the technical support. You have to spread it along both if you're having a discount. Okay. So what was the price of the machine? It was 95,000 earlier, but with 20% discount, you'll be having it only 80%, which is 76,000. So now machine will be 76,000. Coming to technical support, it was 30,000. With 20% discount, that means 80%, it will be 24,000. Technical support, yes. If you add up this 76 and 24, it should add up to 100,000, which is your consideration receivable. It should be always like this. Okay, and when you are, this is regarding transaction price allocated to performance obligation. What about revenue? What about revenue recognition? See, the revenue is recognized when performance obligations are satisfied. Okay, you just write that one sentence, that's enough. And now the fifth step and the last step, revenue recognition. So here, remember, it is not when customer pays you that you recognize revenue, but it is when you have satisfied the performance obligation. That means by transferring the promised goods and services to the customer. Okay, even if the payment is non-refundable, you still cannot recognize the revenue for the payment. Next, when you are going in the contract, okay, in the beginning of the contract, an entity must determine whether the performance obligation is satisfied over a period of time or at a point in time. It's like building a school. Building a school is over a period of time. It takes years. Or if you're selling a car, it's at a point in time. You sell the car and you get the recognized revenue. Okay. Next. So IFRS 15 says an entity satisfy a performance obligation over a period of time. You see, I have underlined it, over a period of time, if one of the following criteria is met, at least one. Number one, customer is simultaneously receiving and consuming the benefit as the entity performs. Okay, this is like teaching. While I am teaching, while I'm doing my action, you are actually you are actually receiving the benefit as a student. So teaching is one example. B, entity performance creates or enhances an asset, let's say work in progress, that customer controls as the asset is created or enhanced. This is like building. You are constructing a building or a school. Okay, it takes years. So while it's in work in progress, okay, it's a work in progress in 1 year, 2 years, 3 years. So in year one and two, the work will not be completed. You will only hand over the school after the third year is over. But in year one and two, it's work in progress that's going on. You are decorating it, installing wires, equipment. Why? To enhance the asset so that it can come up to that condition to be used later on. like building or school, like that, right? So that is over a period of time. C, entity does not create an asset with an alternative use. Okay, therefore entity has an enforceable right to payment for the performance completed to date. That means specifically the entity has performed the asset. Okay, they have, let's say, constructed a building or a school specifically for you. Now if you now they cannot sell it to someone else. It is customized according to you. That building is very unique, right? Or maybe that equipment is very unique that they have created it specifically for you, for one customer. So now even if you are not buying it later on after the completion, you cannot sell it to the another customer. Therefore you have the enforceable right to receive the payment once performance has been completed to date, because alternative uses are not there for that asset. That asset could only be used for the purpose it was created for. Okay, now if performance obligation is satisfied over a time, revenue is recognized over a time. We have seen questions, lots of questions, right, where we have divided it by 12 because for the number of months, right? Revenue is recognized over time based on the progress towards the satisfaction of that performance obligation. Let's say first year they have completed 50% of the work, so your revenue will be 50%. Let's say next year 75%, so 75%, like that. Okay, now we'll do two questions. Test understanding 7. Okay, what is the accounting treatment for events 30th June 2001? On 1st of Jan 2001, they enter into a contract with a customer to provide monthly payroll services, and they charge 120,000 per year. So looking at the word monthly, okay, and also it's a payroll services, so you can understand this is a performance obligation satisfied over a period of time. Why? Because customer simultaneously receives it and consumes the benefit of the payroll processing. Okay, so now on 30th June you have to recognize it was done on 1st of Jan, so only for 6 months you have to recognize how. So 120,000 into 6 months, which will be 60,000. Okay, you will recognize this much of revenue. Coming to test understanding 8. Okay, you have to decide whether it's over a period or at a point in time, the transaction. So on 31st March 2001, they entered into a contract to construct a specialized factory for a customer. Customer paid an upfront deposit, which is only refundable if they fail to complete the construction in line with the contract. Remainder of the price is payable when the customer takes possession of the factory. If the customer defaults on the contract before completion, they only has right to retain that deposit. Understand? First of all, the word specialized factory looks like it's over a period of time, right? Because this is point C from the previous slide. Because they told at least one criteria needs to be made for it to be over a period of time. So equipment is specialized. But hold on, do not be in so much hurry to give your conclusion. There are some more facts to it. It looks like it's over a period of time, right? Because the factory is not used for any other use. Okay, but if you see the third point, the point C, it says it needs to be a specialized asset, but also right to, it has an enforceable right to receive the the amount whatever they have when they complete the performance obligation has been, I mean when they have completed their work, right? When they have completed the work to date, they will they have the right to that payment. But here they don't have right to that payment. The company only has right to retain the deposit if it fails. This and both has, it's an and. Go back and check. Go back to my video and check. It's an and. Both has to be together for it to be. It's in point C only, third point. Both has to be there for it to be over a period of time. But it's a specialized factory, true, but it does not have right to payment for work completed to date. They only have enforceable right for the deposit. Therefore, it's at a point in time, not over, because it does not satisfy point C. Okay. So when is revenue recognized? When the possession of the factory has been given to the customer at a point. When control of the factory goes to the customer, you can say. When control goes to customer, control of the factory. Now we don't know the date, okay? So we'll just leave it like this because we don't know the date when they are receiving the factory. Methods of measuring this progress towards satisfaction. Okay. Now, two methods are there, output method and input method. Output method is based on your performance or time elapsed. Input is the cost incurred in proportion to the total expected cost. Now, if progress cannot be measured reliably, then you need to recognize revenue up to the recoverable cost incurred. Now let's do a small question. Test understanding 9 Baker. Okay. Here you have a construction, you have a contract to build a specialized building for 2 million plus a bonus of 0.4 if the building is completed within 18 months. Okay. So understand that bonus is a variable consideration. Okay. Now, estimated cost is 1.5 million. Okay. If the contract is terminated by customer, they can demand payment for the cost incurred to date. Can demand cost incurred to date plus a markup of 30% if it is terminated. On 1st of Jan, the results of factor outside of his control such as weather and regulatory approval. Becker is not sure whether the bonus will be achieved or not. And on 31st December, they are still unsure whether bonus target will be met. They decide to measure the progress towards completion based on the cost. I told you two methods, input method, output method. They use the input method based on cost. Now, costs incurred on the contract to date are 1. Looks like it's a long question. Too many things, no? Bonus, variable consideration, then progress towards completion, one by one. First, understand constructing building is a single obligation, one performance obligation, constructing building. This is how you need to answer this question. Always start by writing how many performance obligations are there. Only one, that is constructing building. Second paragraph, bonus. Bonus is a variable consideration. You cannot talk obviously about the fixed, nothing to talk about 2 million. Bonus is VC, variable consideration. Should we include it in transaction price? No, because it's unsure that bonus will be received or not. So the likely of reversal taking place is high. Therefore, this must be excluded from transaction price. Okay. You have to talk about reversal all the time. Whenever you say about variable, whether to include or exclude, talk about reversal. Okay, whether it is likely or unlikely. It is unlikely, it is likely because they are not sure of the bonus to be achieved. If it's unlikely if they are sure of the bonus to be achieved. Okay, so based on the wordings you have to decide. Now, so that means the consideration is only 2 million. The 0.4 does not come there of the bonus. We are sure of that. Next, third paragraph. Over time or at a point in time. So constructing a building is over a period of time. Why? Give reasons. 2 reasons. Specialized building, it has no other use. Okay, no alternative use for Baker. Next, payment. What is the payment? They are enforced the payment for the work completed to date. Unlike the previous question where it was only deposit. That's why it was at a point in time. But this is over a period of time because it satisfies this too. Next, The last paragraph is the conclusion. Last paragraph is basically your revenue recognition. It's always like this. Your conclusion is always at the end. So don't jump by starting first with the revenue recognition. It has to come in this order. First, performance obligation. Second, variable consideration. Third, over a period of time or at a point in time. Then comes revenue recognition, one by one. Okay. So they have used the cost. Okay. You need to find it in terms of fraction or decimal. Okay. So what is the cost? Incurred to date is 1 million. Expected cost is 1.5. If you go by this, it is 2 over 3. This is the fraction. So now we'll find the revenue and we'll find the cost. Revenue is how much? That is your consideration is 2 million. 2 million into 2/3. And what was your cost? 1.5 was your total cost. We'll take 2/3 of it, which will be 1 obviously. And 2/3 of 2 will be 1.3. So 1.3 minus 1 is 0.3. This is your gross profit. Okay, this is how you do this. Now, when a performance obligation is not satisfied over a period of time, it is satisfied at a point in time. And entity must determine the point in time when customer obtains the control of that asset. That is the time when they recognize revenue. Next. Now, what is a control? What does control means? An entity controlling an asset means when entity can direct its use, they can have a say of how the asset must be used, and most of the benefit of that asset is going to the entity. That shows that entity is controlling the asset. Control can also mean that you can prevent someone else from having that benefit of that asset. You're preventing another entity from obtaining benefit from that asset. That is also a sign of control. Now, you need to know 5 things. If this 5 is there, it means control has been transferred. These are the indicators. Number 1, whether the entity has a present right to payment for the asset. Entity must have the right to payment for the asset. Okay. Next, customer should have the legal title. Third, entity have transferred the physical possession of the asset. Fourth, customer has the significant risks and rewards of ownership of that asset now. And finally, customer have accepted the asset. Okay. Entity should have the right to that payment to the customer. Customer should have the legal title. Customer should have the physical possession. Customer should bear the risk. Customer should accept the risk. Then control has been transferred. Okay. Now let's do a question. Test your understanding 10, clearance. Okay. How should clearance recognize revenue from the above transaction for 31st December 2001? Now let's read. So this is about supermarket and clearance, our magazines. Okay. On 31st December 2001, clearance delivered the January edition of magazine to supermarket chain. Okay. Legal title remains with clearance. Who has the legal title? Clearance. Until the supermarket sells a magazine to the end customer. Supermarket will start selling the magazines to its customers on this date. That is next year. Not even this year. Any magazines that are remain unsold by the supermarket are returned to clearance. Supermarket will be invoiced by clearance in Feb 2002. Okay. Now, answer I have copy pasted for you to show you how you need to write an answer. You see it said 4, there is spaces between. So first paragraph, second paragraph, third paragraph, fourth paragraph. The answer is in 4 separate paragraphs, around 4 to 5 lines. How? How the answer is, how do you start this answer? What do you write in the middle part and how do you end? Okay. First, you need to talk about whether performance has been satisfied at a point in time or over a period of time. That's what they have told. This is not satisfied over a time. You need to start with the performance obligation always. So this is not over a period of time. Explain why. Why not over a period of time? Because supermarket. Why? It does not simultaneously receive and benefit from the asset. So therefore, if it's not satisfied over a period of time, you need to give the correct reason. It's satisfied at a point. Okay. And at a point means it will recognize revenue when it transfers the control of asset to the supermarket. When clearance transfers the control of the asset to the supermarket. That is the first. Second, we'll talk one by one. Remember the 5 indicators? When control has been passed or not, we are going to talk about those 5 indicators in the answer one by one. Second, let's start with the physical possession. Who has the physical possession? The fact that the supermarket has the physical possession of the magazine, because they have to sell it to the customer. It's not the clearance. Supermarket has the magazines. It is an indicator that control has been passed. You see, one indicator they've explained. Next, also means it's supporting that control has been passed. Clearance will invoice the supermarket for any issues. That means supermarket does bear some of the risk of ownership. So these are for control passed. Second paragraph says control has been passed by giving 2 reasons. One, physical possession. The other one, risk. Supermarket bears some risk. Next, however, so these are the correcting words. You should know these correcting words. This is basically your English language. I'm not teaching SBR here. I think I'm teaching an English course here. You need to know these correcting words. First, you start with the reasons for saying that something has passed. Okay. Then, however, but only 2 things are there. Risk, and that means the remaining 3 says control has not been passed. That's what you are writing in the third paragraph. However, you need to mention the date also. Very important. Legal title has not passed to the supermarket. Legal title of the magazine did not pass. Next point. They have no right to receive payment. Clearance has no right to receive the payment until the supermarket sells the magazine to its customer. So that's the second point. And the third. And finally, the third point. Significant risk of ownership is borne by clearance. Some, yes, we said they will bear some risk. But here, significant risk of ownership is by clearance because they will send any unsold issues and so bear significant risk. So you see more points. How do you decide? Because you are giving both the side. The side which has more points, you are going by majority. Okay. Then all things considered, this is how you conclude always. You can write in conclusion or summarizing or looking at the whole picture. Anything like that you can start with. Okay. So now after considering all the things, you are giving a conclusion. Last paragraph is always the conclusion. Your final answer. All these are reasons you are supporting. You are coming up from all this to your final answer. This is how you need to reach your answer. Okay. It seemed that control of magazine has not passed from clearance to supermarket chain. Not passed. Therefore, just saying it did not pass will only give you 1 mark. You will lose another 1 mark. You have to give reasons for revenue recognition. Therefore, clearance should not recognize revenue from this contract. Why? Control has not been passed. So how can you recognize revenue? So clearance cannot recognize revenue from this contract for the year ended this date. Okay. Now, consignment sales. Okay. Sometimes entity delivers product to dealer. That means an intermediary, an in-between person before it reaches to final customer. Okay. They are delivering it to a dealer or a distributor, and then that distributor is selling it to the end customer. So in this condition, to recognize revenue, you have to see the terms and conditions. Okay. Between the first entity and the dealer. You will look at this terms and condition to decide whether a sale has occurred or not. Okay, if control of the good has not passed to the dealer, you do not recognize revenue because this transaction is then known as consignment if the control of the good has not been passed to the dealer. Next, these are the key indicators that an transaction is a consignment. Number 1, product is controlled by the entity until a specified event happens. Okay, like dealer selling the product to a customer or expiration of a specified period. Okay, until the dealer sells the product to the customer, if the product is controlled by the entity, it's a consignment. Next, entity can require the return of the product. Consignment. Third, the dealer has no unconditional obligation to pay for the product. Okay, if these three are there, it's a consignment. Now let's see how we deal with consignment. Test your understanding 11. Gazebo. Discuss when gazebo should recognize revenue. Okay, gazebo sells furniture to garden center. Okay, gazebo retains the legal title until the garden sells the furniture to the end customer. Okay, at which point garden center has an obligation to pay gazebo. The garden center can return the unsold products to gazebo, and gazebo can then recall the unsold products at any point. Okay, now how do you answer this? See, revenue needs to be recognized when control has of the furniture transfers has been transferred. Okay, now physical possession is there, yes. Okay, when garden center accepts delivery from gazebo, it has physical possession of the furniture. But just because they have a physical possession, you cannot say control has been assumed. Why? Because if you see gazebo, okay, they have right to recall the unsold products at any point. They have rights to call back the products. They can choose to withdraw them from the cell or deliver them to another customer. So you see gazebo. Gazebo is having, still gazebo has the right to direct the use. Gazebo has right to direct the use. Still gazebo has the right to direct the use. So gazebo is not entitled to payment until sale to the end customer. If you are selling to the end customer only, gazebo will get the payment. Otherwise, no payment. So this is a consignment. Because in consignment they say this is a consignment arrangement. That until, okay, the payment has not been made to the end customer, you're not going to get any payment. Okay, gazebo is only entitled to the payment when the sale to the end customer by the garden furniture has been made. That's why it's a consignment. So it's a consignment. Gazebo has to recognize the revenue. Okay. When should they recognize the revenue? When? Because this is consignment. When garden center sells the furniture to the end customer, then gazebo will recognize revenue. Contract modification. So we are done with revenue, the 5 stages of revenue recognition. Now we are moving on to contract modification. Okay, we know that contract could be modified, right? It could be changed. A contract modification could be a change in the scope or the price of the contract. Let's see. A modification is accounted for as a separate contract if, okay, the scope of the contract increases, then it's taken as a separate contract. If the scope of the contract increases, how? Because of addition of goods and services, distinct goods and services in the contract. Now you're putting more goods and services. Okay, next, the price increases. The price might increase because of the additional goods and services. Okay, so under both of this, it is taken, this modification is taken as a separate contract. Moving on to the next. Okay, if it is not accounted for as separate, then modification is accounted according to two ways. Number one, you terminate the existing and you create a new contract. Only if goods and services, okay, the remaining goods are distinct from those before the modification. There should be a difference between this. Then only termination of existing and creation of new. The two goods are different before and after modification. Okay. Now, how do you deal with the transaction price for it? The transaction price for this new contract is the total of original consideration unrecognized, additional consideration from modification. Add the two. Second way, if it is not a separate contract, it is a part of an original contract, the modification. How? If the goods and services are similar before and after modification. They are not very distinct. So they can form a part of a single performance obligation. Okay, but this will impact your contract price. Because it's a part of original contract, contract price might go up and down. And also, now it might take more time for you to complete. So stages of contract completion. Okay, this also will change. How do you deal with it? You deal with it by adjusting the amount of cumulative revenue that you have recognized at the modification date, if it's a part of an original contract. Now let's do a small question on contract modification. Just understanding 12 salty. This is a little lengthy. Okay, you need to go a little slow because otherwise you can lose the track and you might get lost. Okay, it has lots of calculations and it could be a little tricky. Okay, but it's not at all impossible to do. A. Discuss with calculation how much revenue they should recognize by the reporting date. B. Discuss with calculation again how much revenue should be recognized if the contract specified a price of 40 for the additional 200 products. Assuming normal standalone selling price at the modification date is 57. Okay, first we'll go by A, when modification has not been done. Okay, so by the reporting date they have transferred 900. Okay, and each is sold for 60. So according to A, it is 900 into 60, which is 54,000. This much revenue they must recognize. Okay, this is according to the original contract. See, we didn't read the case study. Okay, they enter into a contract to supply 1000 product for 60. Okay, over a 8-month period. They transferred 700. After that, they modified it to 200 additional products. That means 1000 plus 200, total 1000. Selling the price of additional 200 is 57, which is a standalone selling price at the date of the contract modification. Okay, by the date they have sold 900. So first you need to understand this is a contract modification. But what is it accounted as a separate or not a separate contract? It is accounted as a separate contract. Why? Because products are distinct. And the price increases reflects the product's standalone selling prices. And so they have got the revenue. Okay, this is according to the original contract. Now coming to B, after modification. Okay, you need to first identify whether it's a separate contract or not a separate contract. Okay, so here you see the contract price increase. Okay, somewhere they have told it. Okay, so the contract price increase does not reflect the standalone selling price of the good. So the modification is not accounted for as a separate contract. Modification is not a separate contract according to B. Why? Because the contract price that has been increased does not reflect the standalone selling price of the good. Okay, you see, at the reporting date is 40, but modification is 57. There has been increase in selling price, but this increase does not reflect the standalone selling price of the good. We still don't know what is the standalone selling price of the good. Okay, Now, that's why it is not accounted for as a separate contract. Okay. So because it is not a separate contract, there are two things: terminate existing and new, create new, or part of original contract. Which one is this out of these two? In the previous slide we went through this. If it's not a separate contract, which one? It is this one, the first one. Terminate existing and new. Why? Distinct. The goods are distinct. That's why. Okay. So now, by the contract modification, what happens? 700 goods has been transferred. After, like, total 900 has been transferred, but out of that 700 before modification. Okay. And 200 after modification. So 700 has been transferred. Okay. What is it? Contract to supply at 60 each. The price is 60. So 700 into 60, which is 42,000. This is the revenue. Okay. Now the original contract will be cancelled. Okay. A transaction price should be determined for the new contract. Original contract is cancelled, and now you have to determine a transaction price for the new contract. Determine TP for new contract. You have to find it out. You first have to find this one. This needs a working. Okay. So how do you get the transaction price for the new contract? Method has been given. Unrecognized consideration from the original contract, and you add the additional consideration of the modification. So which has been unrecognized from the original consideration of the original contract? You see, you have 700. Okay. But you had a contract to supply 1000. Out of it, 700 you have done. That means 300 was not supplied. Correct? 300 was unrecognized from the original contract at price 60, because 60 is the price. So 300 into 60. This is the unrecognized from the original contract, which is 18,000. You add with it additional consideration from the modification, from the new contract. Okay. What is it? So additional is what? 200 into what? What is the price? They have given you the price. Contract specified a price of 40 by the reporting date. So 40 you have to take, which is 8,000. You add both, it becomes 26,000. Okay. So once you get this, you have to find the price per product. Remember, you have to find a transaction price per product. It's very important. I know this looks a little lengthy work and you're not understanding why we are doing all this, but you will understand. Hold on. So 26,000 is the total. Divide by total number of products. That is 300 and 200. 500. Which is 52. 52 is the price. Okay. You need it. So when 52 is the price, now how much will be revenue? After modification. Okay. 200. So 200 products at 52, which is 10,400. This you will add with what? With 42,000 from the old contract, which adds up to 52,400. This is your revenue that you need to recognize. Total revenue. This 42,000 comes from here, by the way. This 42,000. The one where you are selling 700 at 60. Nothing has changed here. That remains same. Only the 200 part. We did all these steps just to find this 52, so that we can multiply it by 200. This is the new contract. We need this price. We needed this price actually. We know 60 for 700. So we added. That's what we did. From contract modification, we are moving on to contract cost. You can capitalize contract cost and recognize it as an asset. Okay. These are the costs that you can capitalize. Number one, two types of cost. Cost of obtaining a contract, cost of fulfilling a contract. Cost of obtaining a contract excludes all those costs that are anyways incurred, whether the contract was obtained or not. Anyway, you are going to incur them, like legal fee or cost of traveling to a tender, right? You have to exclude this cost. Only those costs that are specifically for obtaining a contract. That means if you didn't obtain that contract, you would have not incurred those costs. Only those costs you can capitalize. The next type of cost that you can capitalize are the cost of fulfilling. Okay, but remember, this if it does not fall under the scope of any other standard like IS2. If it falls under IS2, then IS2 rules apply. Okay, but if it does not fall into within any other standard, then you can capitalize it. And the entity expects them to be recovered. Remember, cost of fulfilling, you are expecting them to be recovered. Okay, only then you can capitalize. So you add both cost of obtaining and fulfilling a contract. The capitalized cost of both you add and you amortize. Why? Because it's an asset now. Once you capitalize it, it becomes a non-current asset. Okay, so you capitalize. You once you capitalize, you amortize it. Why you amortize it? Because it's not a tangible asset. Remember, this contract costs and all, they are intangible asset. They are intangible, they are not tangible. You cannot touch them. Can you touch the contract? Like you can touch the land or machines or building, you depreciate, but this one you amortize like other intangible assets. Okay, remember, cost, these are capitalized cost. The contract cost, you cannot touch them, they are not tangible. That's why they are form of an intangible asset. Therefore, you amortize them after capitalizing in the statement of profit and loss. And all the other costs, general costs, cost of wasted labor and materials. Obviously, there will be so many labor that are wasted, lying idle, or materials that are wasted. They will go as an expense in the P&L. Okay, let's do last question for this lecture. Test understanding 13. This is the last question for this lecture. Very short. You have been given 3 expenses and you have to know which one to be capitalized. First is research cost, 30,000, traveling cost 20,000, and commission 15,000. Only 15,000 you can capitalize. This too goes as an expense in the P&L. Why? You have to amortize it. Because this 15,000 cost is incurred only when you win, when you are successful. Okay, so this 15,000 only is recognized as an asset. Okay, this cost will only be incurred when the bid is successful, and you can recover them also through the fees that you can earn from the new contract. You can recover back this cost. But what about external research and travel? Anyway, you would have incurred whether the bid was successful or not. So these are expensed in the P&L. Presentation on the statement of financial position. Now, we know that how to recognize revenue using the 5 steps. Then we went through contract modification and the contract cost. Now, how do we present it on the statement of financial position? This is how we do it. When an entity has recognized revenue before it has received the consideration, you have to recognize it either of these 2 ways. Number 1, receivable, if the right to consideration is unconditional, or a contract asset. Okay, it's like a debtor. Okay, it's like your trade receivable, you can see, where you are selling goods on credit. You have not yet received, but you have recognized revenue. It's like that. Okay, so here take it from the point of a contract. Okay, it's the same thing. So either you recognize a receivable or a contract asset. If it's the other way around, okay, where you have received the consideration before you recognize the revenue, it's a contract liability. Okay, now for it to be unconditional, okay, an entity has an unconditional right to receive consideration if only a passage of time is required before payment is due. That means some time should pass before payment is due. for you to say that you have an unconditional right to receive consideration. Okay, now, so that's it. Depending on it, whether revenue is recognized first or later, you have to recognize a contract asset or a contract liability. Okay, now moving on to the disclosure. IFRS 15 says an entity needs to disclose these things. Number one, revenue that is recognized from contract. Two, the contract balances and assets from fulfilling and obtaining contracts. Okay, then any judgments that you have used, significant judgments used, and any changes in judgment. Now we are moving on to the judgment. This is the last part of this lecture. Okay, management judgment is often required in revenue recognition. For example, okay, contracts with customers need not be in writing all the time. Okay, let's say in the past you have a practice of delivering a certain good or service. So based on that, even in future, you have a constructive obligation. It is expected of you to deliver that good or service, even though it's not written in some contract. It's known as constructive obligation. Okay. Second, a contract. Okay. For you, okay, a contract can only be accounted if it is probable that entity will collect the consideration. Whether this benefit is probable, okay, is a judgment. Third, regarding distinct performance contract, okay, entity must identify a distinct performance obligation in a contract. Sometimes what happens is the past performance give expectations that a certain goods and services that are not specified in the contract will be transferred. So this identification of distinct performance obligation is entirely on the management judgment. Okay, both the contract terms. Okay, and the impact of the entity's past behavior on customer expectations. Next, variable consideration. Here also you need judgment. Why? Because variable consideration can only be included in your transaction price if the probability of revenue that has been recognized reversal is not high. Okay, if it is unlikely that reversal will take place, then only you can include, otherwise no. Here also you have to make a judgment. Judgment of what? Whether the performance target will be met or not. Next, transaction price. Regarding the fourth step, allocating transaction price to performance obligation. This is also based on some observable and standalone selling price. Wherever observable prices are not there, you have to make estimates. An estimation is judgment. And if a performance obligation is satisfied over time, okay, you recognize revenue towards the completion of the performance obligation. But there are various ways to measure that completion, input or output method. And here also, entity must determine which of the two methods most faithfully represent the transaction. Is it the input or is it the output? Then the last, if the performance obligation is satisfied at a point in time, here also entity should use judgment, the date at which control has been passed to the customer. Okay, now because this revenue recognition has so many judgments, it increases the risk of management. Okay, it increases the risk that the management can manipulate the profit. To show in a favorable position, they can easily manipulate because judgments are required. It's hard to verify judgment. Evidences are not there. It's your own judgment, right? That's why you have to comply the ACCA ethical code here in the revenue recognition. You see how they are linking this with ethics, which comes in your question number 2, where 2 professional marks are there. Okay, ethic question is a question that you are going to get definitely in SBR exam. Okay, with 2 professional marks. So in that question, ethics question, they might give IFRS 15 as a part of it. So be very careful. This standard IFRS 15 can be asked from 2 viewpoints, either as a standalone question or combination with ethics. Okay. Now, so let's summarize IFRS 15. We started with 5-step approach: identify contract, identify performance obligation, determine transaction price, allocate transaction price to performance obligation, and recognize revenue. Revenue can be recognized over a period of time or at a point in time. Okay, so this 5 steps has been explained in detail. Please go back to my video back to check, okay, in case if you forgot. But by now you should be knowing something. You have a clear idea, picture right now. Okay, contract cost. Capitalize the cost of fulfilling and obtaining the contract. I forgot to add that. Okay, next, and any other cost that is not capitalized goes as an expense in P&L. Okay, presentation, you present as a contract asset or contract liability. Okay, if you are recognizing revenue before receiving consideration, contract asset. If it's the other way around, contract liability. And the disclosure. So that's it for IFRS 15. There are plenty of questions in your revision kit in IFRS 15. Please go and do all of them today, okay, without even wasting a minute. So see you in the next lecture, which is IFRS 16. And do not forget to subscribe to my channel if you haven't subscribed. Thank you.